Hi everyone. This week's episode we are calling it as a decimation of select technology stocks and Chinese equities. Overall, global markets did well last week, particularly in the US and in the Europe, but the China index lost about 5% and the Hong Kong index lost about 8%. The market is a great teacher, and this week the market again taught us why to treat volatility as your friend. This year, this was the fifth time that when the volatility index touched the level of 30, and from there the markets rallied by 10-15%. So the lesson to be learned is that not to panic at market bottoms. When we look at the top 10-11 markets of the world, what we see is that the worst performing markets are China and Taiwan. And China is down about 35% in the local currency terms. Taiwan is down more than 40% in dollar terms. India, of course, has been doing extremely well, and we try and look at India's superior performance in a framework we called as V-SAFE. V for volatility, S for sentiment, A for absolute and relative valuation, F for flows, and E for earnings trajectory. When you look at volatility, we find that Indian equities and bonds both are witnessing very low volatility. With regard to sentiment, both in equities and bonds, again, a buy on dips kind of a strategy has been profitable for investors. Valuations, of course, absolute and relative valuations are very high for Indian equities and also for bonds. Flows for domestic institutional investors and for foreign investors, the flow is kind of slowing down. But when we look at the HNI segment and the retail investors, I think the flow is fairly strong. And these are the categories of investors who are taking the markets higher. Lastly, the earnings have been resilient, and there is no trace of recession or slowdown in the globe, and even if it is there, it is not reflected in Indian earnings. And talking about expected earnings for the next year, what we see is that for 23 and 24, India will enjoy the highest earnings growth anywhere in the world. CMI has looked at the results of 427 companies for September quarter, and interestingly, what they have found out is that for financials, there's been a growth in profitability in excess of 40%, whereas for non-financial stocks, there's been actually degrowth in earnings to the extent of 10%. In an interconnected world, one has to see what is happening in other countries. It has implications for us. So looking at the data coming out of Germany, we see a GDP growth rate of 0.3%, and that's better than expected. And then an inflation of 11.6%, which is also worse than expected. But the market is still ignoring these numbers because there are evidence to show that this is probably the peak inflation that Germany is having. Now, there's been an interesting research done by Goldman Sachs about outsourcing from the Europe region because of high energy prices, and they have showcased the case for the chemical sector. And what they are talking about is that there are a lot of industries which might move out of Europe and move to many Southeast Asian countries where India could be a beneficiary. India benefited from China plus one policy, and now it looks like it's set to benefit from Europe plus one policy. China has multiple O's. One of them is the property sector. And interestingly, what we saw is that the share of GDP for Chinese real estate is 2x of the combined wealth of equities and bonds put together. So it's the biggest sector of the world, and anytime the Chinese real estate sector gets into stress, it hurts the economy. And so it's the technology stocks which are not doing well in China because of the risk of delisting, given that they don't submit proper accounts to the regulatory authorities in the US. There is the geopolitical risks surrounding what it proposes to do in Taiwan. Thirdly, there was no significant takeaways from the latest Congress plenary session that they had, and all this has contributed to 81% fall for China technology ETF from the peak. Now, with all this weakness in China and India, kind of managing it responsibly, since in the last 18 months, the weight of Chinese stocks in emerging market index has come down from 40% plus levels to 25% levels. And for India, it's gone up from less than 10% to more than 15% now. So that and only two countries have lost their weights. These are China and Taiwan, and no prizes for guessing why the weight is for these countries have come down. US reported a third quarter GDP growth rate of 2.6% after contraction in the previous two quarters, and 1.4% of this has come from consumption, 2.8% from net exports, while there has been a drag from property sector to the extent of 1.4%. We have several acronyms that we counter in stock markets. The latest one is FANGMAN, consisting of Facebook, Apple, Netflix, Google, Microsoft, Amazon, and Nvidia. And what we see is that their stock prices, combined market cap has declined by more than 40%. And just think about it, Apple in fact is the biggest company, and that stock has gained over the last 1 year. So, if you exclude Apple out of all this, then the damage is far more significant. Last week we saw decimation of select technology stocks, to name a few. We have Amazon, Meta, Microsoft, and Google. And you look at the weekly charts and you feel as if this has been a kind of a 1 year chart. That's the kind of damage that happened last week. Reacting to the correction in technology stocks, Uday Kotak tweeted something, and in reply to him, Mr. Manish Chokhani has put out three graphs. The one which again shows how the liquidity went up significantly because of the pandemic, etc. Central banks all over the world pumped in liquidity. So one is to blame these companies for not having delivered. Other is the role of interest rates played in valuation of these companies. At the height of pandemic, that US 10-year was 0.5%. Now it's more than 4%. So when you value growth companies based on discounted cash flow basis, this rise in interest rate results in a lower fair value for these companies, and hence part of the correction is because of the central banks, not so much because of poor working of these companies. Another interesting chart is that, which I didn't know, that Bank of Japan is a listed entity, and that stock has corrected from 700 plus yen to about 25 yen now. And and the investors there are telling the central bank, boss, something is wrong. Otherwise, why would the stock decline from 700 yen to 25 yen? Now the markets have done well in the recent times, with S&P 500 going up about 10-12%, and that's because the market thinks that okay, the Fed pivot is somewhere near. Now if you are not in that camp which thinks the Fed is going to pivot, which basically means stopping rate hikes and cutting rates, then you should take this rally as an opportunity to lighten up and keep the cash aside so that you could buy on market declines. Coming to the bond markets, the bond markets rallied all over the world, basically because of a couple of reasons. One is because of the developments in United Kingdom, and second is because of this chances of Fed pivoting. And whether this is sustainable or not, only time will tell. When we try and judge the credit quality of a company, we look at the shares placed by the promoters, and INRA and ASO Equity, they have come up with an analysis of pledges by corporate, and you want to understand the stress level in sectors of various companies, it makes sense to refer to that report. One man's pain is another man's pleasure, as they say. So today, if a borrower is having to pay higher interest rates, it's the lender who is laughing all the way to bank. So if you have a 40-year mortgage and the rate of interest is 7%, and you borrow 100 rupees from the bank, then you end up repaying 300 rupees, 100 rupees of principal and 200 rupees of interest. So the lenders are in a much enviable position today because of higher interest rates. And as a result of higher mortgage rates, obviously the housing sector is getting impacted, and the US pending home sale index has fallen for the month of September. 2-3 weeks is a long time in markets today. If you look at the OIS curve for US bonds, you will see that the market is trying to price in a Fed pivot and possible a lower peak rate for Fed fund futures, and possible rate cuts fairly early on. Now this is without even a single Fed governor talking about it. So on 2nd of November we will see what the Fed does and what does it speak. We expect a 75 basis points a hike on 2nd of November, and followed by a 50 basis points hike in the month of December. Coming to crude oil, that gained more than 2% last week. What is happening is that the OPEC petroleum cuts coupled with the geopolitics is overwhelming cut in demand on account of slowdown or recession, as they say. Now, when we come to gold, gold is something which forms an important part in asset allocations. There are few things going for gold today, like for example, the high inflation all over the world. Gold as an asset class is witnessing lower volatility than equities and bonds. The central banks will keep buying gold and adding to their reserves. And lastly, the greater chances of recession. In fact, the probability of a hard landing is also going up, and in that kind of a scenario, gold does better. But we also need to be mindful of negatives. The higher bond yields make bonds more attractive. The dollar is still fairly strong. There's weak jewelry demand in China and India. And lastly, the geopolitical risks premium is that much lower, because if you recall, in February, March, the whole world was talking about Ukraine-Russia conflict. Today, it hardly makes any headlines. REITs and InvITs didn't do particularly well last week. And lastly, we want to talk about the risk capital dwindling. What we are seeing is that the venture capital money coming into India is down 22% in the last 9 months, and particularly in September it is down 28%. So this is what happens when liquidity is drained out of the system. For example, you will find very little money getting into cryptos, for example, because that kind of liquidity is not there. In bonds, you will find less money chasing high yield bonds. Similarly, in equities, getting into those startups and venture capital is something that will get impacted, and that's not great for Indian startup ecosystem. Thank you for watching, and hope you guys have a great week ahead, and see you again next week.